Today, keep on keeping on. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the Property Imperative Weekly to the 16th of March 2019, our digest of the latest finance and property news with a distinctively Australian flavour. The talk is now of more sustained property price falls, the RBA cutting rates, and risks in the broader economy building. And the news just keeps on coming and reconfirming our central scenarios. That said, it looks like the global economy will be stoked by more stimulus for a time. So the question becomes, will we be the first to crack? And by the way, if you value the content we produce, please do consider supporting our efforts. You can make a one-off donation via PayPal. Here's the link, or consider joining our Patreon program. Again, here is the link. We really appreciate your support to help us continue to make great content. And the links are also in the comments below. So straight into the property markets first, with the CoreLogic index to the 14th of March falling another 0.13% in the past week. Over the past 12 months, the index has fallen by 8.3%, driven by Sydney, Melbourne and Perth. And since the last peaks, dwelling values have fallen by 9.4%, led by Sydney down 13.6%, Melbourne down 9.9% and Perth down 17.8%. And the auction clearance rates were weak again on low volumes, with the final clearance rate in Sydney sitting at 52.3% and Melbourne at 49.2%, while the other states all stood around 29%, including Canberra. And the final auction clearances were still 9.9% lower in Sydney and 21.6% lower in Melbourne, below the same weekend last year when dwelling values were also falling. Moreover, auction volumes were down 28% and 52% respectively in Sydney and Melbourne. So there are no signs of recovery here. Taking a longer term view, it's worth reflecting on CoreLogic's latest Property Pulse, which says that at a national level since 1980, there have been 8 separate housing downturns. The current downturn, which commenced after October 2017, has seen values fall by 6.8%. Although that may not seem like a substantial downturn, since the early 80s there have only been 2 downturns which were larger, 2008-9 and 1982-83. National housing market downturns have also generally been fairly short-lived, with the current downturn of 16 months already the second longest, with the 2010-12 decline running 2 months longer than the current downturn. The decline in values throughout the current downturn has been larger across the combined capital cities, with values now 8.6% lower, and by next month, assuming the falls continue, this will be the largest downturn in the combined capital city index any time since 1980. And the current downturn is also closing in on being the longest. With values having peaked in September 2017, they have now been falling for 17 months, with the previous longest period of decline coinciding with the last recession running for 20 months, between 1989 and 1991. Now, of course, it's worth remembering this one is being driven by right-sizing credit, not rising interest rates or unemployment. But ahead, we do expect unemployment to turn upwards and the RBA to cut the cash rate. But this may not automatically translate to lower mortgage rates. And if credit supply remains predicated on lower loan-to-income ratios and more forensic analysis of income and expenditure, then prices will indeed continue to fall. We will get the odd unnatural act, such as extra first-time buyer incentives or ANZ's loosening of terms for interest-only loans, which we discussed in yesterday's post. But unless we go back to the illegal behaviour revealed through the Royal Commission and lending standards drop substantially again, credit will remain tight. And we're watching the apartment market in particular as demand fades and the quality of construction question comes to the fore. Indeed, the UBS Property Roundtable made the point that apartments are increasingly out of the money. That's where you get settlement issues. What's happened to buyers now as they come to settlement is bank valuations might come in 10% or even 20% below the contract price. And the bank is also probably assessing you with more stringent expenses, potentially haircutting any bonus or commission or other income a bit more. As they reassess you on tighter lending standards, you might find that your borrowing capacity is significantly reduced, particularly if you are a repeat buyer who already has other debts, and they are realizing that you are already on 6 or 7 times debt to income. And there are signs of construction of existing towers stalling, according to the AFR. An analysis by the Australian Financial Review of CoreLogic data showed about 21,000 out of about 36,000 approved apartments in Melbourne, worth around $6.5 billion over the past 2 years, have been categorised as deferred or possible, but have not firmed up to go ahead. And in Sydney, just over 10,000 out of 26,000 units with an end value of around $3 billion are in the same boat. And data from construction information provider BCI Australia confirmed the pattern in Sydney and Melbourne, adding that the ACT was the only state where almost all approvals in 2015, while much fewer than New South Wales and Victoria, proceeded to construction. And something else to bear in mind is the rise of Airbnb-type short-term letting. As the New Delhi reported, Airbnb spends a lot of time saying they have no impact on markets. What this paper shows is that they do, University of Sydney Professor Peter Phibbs said, referring to the recent RBA modelling. The RBA report found that vacancy rates are the strongest predictor of rents, Professor Phibbs said. And while that in itself seems pretty obvious, it also shows the conversion of long-term rental stock to Airbnb-style type tourist accommodation is reducing rental stock and subsequently reducing vacancy rates. Hobart is the standout because they have the lowest vacancy rates in the country, and they've probably also got the highest take-up of Airbnb. And we know from our surveys that households are expecting home prices to fall further, as revealed in our latest data out this week. See, what are households thinking about now? Demand for credit is easing too. And we know from our earlier surveys that mortgage stress is rising as income remains constrained. WA is being hit hard, as reported in the West Australian. In January and February alone, 112 people sought help from Legal Aid WA after defaulting on their home loan repayments, more than a third of the number of people who sought assistance in 2018. The 2018 figures saw Legal Aid support 301 people, a 550% increase from 2013 when only 46 people had required help. The dramatic jump in cases has prompted Legal Aid WA to launch outreach facilities of the statewide mortgage hardship service in 3 locations in Perth's worst affected suburbs. LAWA's Director of Civil Law, Justin Stevenson, said, concerningly, the ongoing financial hardship in the Western Australian community, with a sustained softening of property prices, unemployment, and an end to interest-only loans, means we are only going to see more struggle to pay their mortgage in 2019. Without assistance from LAWA, homelessness is a real consequence for those Western Australians. Next, mortgage arrears continue to tighten, according to the S&P Global Ratings' latest edition of RMBS Performance Watch Australia. Arrears on the mortgages underlying Australian residential mortgage-backed securities, or RMBS, have increased year on year, while prepayment rates have slowed. In particular, arrears that are in an advanced stage, more than 90-day plus, reached a record high of 0.75% in December 2018. Arrears in this advanced stage now represents 55% of total loans, up from 40% 5 years ago. And prime mortgage arrears have increased to 1.38% in December 2018 from 1.30% in December 2017. Softening macroeconomic conditions are likely to keep arrears elevated over the next 12 months, given that borrowers' refinancing prospects, particularly in the current environment of tightened lending conditions, are more challenging. So while they expect to see most borrowers able to manage these headwinds, loans in the more advanced arrear stages, they say, are less likely to cure in the current environment. Meantime, the economic indicators worsen. For example, Roy Morgan's alternative unemployment indicator of 9.6% for February is significantly higher than the average ABS estimate for January 2019 of 5%, although Roy Morgan's underemployment estimate of 8.6% is comparable to the current ABS underemployment estimate of 8.1%. According to the ABS definition, a person who has worked for 1 hour or more for payment, or someone who has worked without pay in a family business, is considered employed regardless of whether they consider themselves employed or not. The ABS definition also details that if a respondent is not actively looking for work, i.e. applying for work, answering job adverts, being registered with Centrelink, or tendering for work, they are not considered to be unemployed. Now, the Roy Morgan survey, in contrast, defines any respondent who is not employed full or part-time and who is looking for paid employment as being unemployed. And since Roy Morgan uses a broader definition of unemployment than the ABS, it necessarily reports a higher unemployment figure. And in addition, Roy Morgan's measure tends to be far more volatile, owing to the fact that it draws on a smaller sample than the ABS and is not seasonally adjusted. Now, the impact of the Royal Commission into the financial services sector continues to be watered down as Jos Frydenberg walked away from his plan to ban mortgage broker trailing commissions, pushing the issue to a review in 2022. The Treasurer said that the government had bat-flicked on its crackdown on the industry because it wanted to keep competition in the mortgage market, amid concerns that only the largest banks could afford to pay steeper bonuses to brokers. The issue will be reviewed in 3 years, if the coalition remains in power, by the Australian Competition and Consumer Commission and the Council of Federal Financial Relations. Now, there is a real issue of competition here, but remember that the underlying issue is the conflict arising when a broker is paid more for recommending a larger loan. And once again, therefore, consumers lose to political expediency. And the data this week continues the bad news, as nicely summarised by Westpac. Markets are now giving about a 50% chance of an RBA cut by June, up from a 40% chance immediately following the December quarter GDP release. Westpac continues to favour moves coming later in the year, August to November the likeliest timing, with the bank still seeming reluctant to cut and likely to require more evidence around the consumer housing nexus and the labour market outlook before taking action. The NAB Business Survey indicates that both business conditions and business confidence weakened in February, with both at below average levels. The Business Conditions Index fell by 3 points to +4, down sharply from the average +18 read over the first half of 2018. And business confidence also fell by 2 points to +2, and we see the soft business update as a significant development, they said. The February read is less affected by holiday season volatility and is a clearer confirmation that the sharp loss of economic momentum since the mid-2018 has extended into 2019. That is consistent with Westpac's view of GDP growth running at a below-trend 2.2% pace in 2019. The detail shows particularly weak conditions for retail, and the December-February period marking the weakest 3-month run since 2013, and construction saw conditions dip as well. The state breakdown continues to show a sharp loss of momentum in New South Wales and Victoria. All of this is consistent with increasing negative spillovers from the Sydney and Melbourne housing corrections. Importantly, the shift is clearly starting to affect business willingness to hire and invest. While the employment component of the survey moved sideways in the February month at +5, it continues to show a clear easing from the +11 averaged over the first 9 months of 2018. And meanwhile, the March survey points to downside risks from investment, with capacity utilisation falling to below average levels and capital expenditure plans down to a 3-year low. And consumer confidence is also starting to falter. The Westpac Melbourne Institute Consumer Sentiment Index fell 4.8% to 98.8 in March from 103.8 in February. The move takes the index back below 100, indicating pessimists again outnumber optimists, in contrast to the cautionary optimistic reads that prevailed through 2018. At 98.8, the index is still only cautiously pessimistic and comfortably above the average level recorded in 2017. However, the March fall looks likely to be sustained, with the survey detail indicating the poorer run of economic news is starting to weigh more heavily. Indeed, responses collected after the March the 6th GDP release were much weaker, consistent with an index level of just 92.7. And we suspect that the National Accounts release clarified what were previously somewhat mixed signals about the extent of Australia's growth slowdown. As such as this aspect of the March weakening in consumer sentiment looks likely to be sustained. Other aspects of the March Consumer Sentiment Survey also suggest the shift is starting to have a bearing on decisions. Job loss concerns rose sharply in the month. The Westpac Melbourne Institute Unemployment Expectations Index recorded an 8.9% jump, indicating more consumers expect unemployment to rise in the year ahead. And responses to additional questions on the wisest place for savings also showed risk aversion rising to extremely elevated levels. 2/3 of consumers favoured safe options like bank deposits, superannuation, or paying down debt, and just 17% nominating risky options such as real estate and shares. And the mix is more risk adverse than at the height of the global financial crisis. Now, we can assume significant stimulus in the upcoming budget, but then that could, of course, all get swept away with an election due soon after, and the chance of a change to Labour, which would reset the agenda to some extent. So it's safe to say we just keep on keeping on. So now let's look at the indices in the Australian market. The ASX 100 closed down 0.05% on Friday to end at 5,079 and is up 4.03% from a year ago. The local volatility index was down 1.09% on Friday to end at 1164 and is down 11.3% from this time last year. The ASX Financials Index is down 0.23% to end at 5,907 and is down 7.8% from this time last year. ANZ was down 1.01% to end at 2635 and is down 7.34% from a year ago. CBA was down 0.85% on Friday to end at 72.31 and is down 5.76% from this time last year. National Australia Bank was up 0.56% to end at 25.21 and is down 16.26% over the last 12 months. And Westpac was down 0.45% to 26.48 and is down 11.44% over the last year. And interestingly, Maurice Blackburn has now launched a website where Westpac customers with a home loan can sign up to be part of the class action. The Bank of Queensland was up 0.33% on Friday to 9.21 and is down 21.5% over the last year. Suncorp Group was down 0.37% to 13.52 and is down 1.24% over the last 12 months. Bendigo and Adelaide Bank was up 1.03% to 9.81 and is down 8.39% over the last year. AMP was up 0.88% to 2.29 but is down 56.44% over the last 12 months. Macquarie Group was up 0.80% on Friday to 27.74 and is up 20.23% over the last 12 months. Genworth Mortgage Insurance was up 0.81% to 2.50 and is up 2.24% over the last year. Mortgage Choice was down 3.47% to 97 cents and is 53.2% lower than this time last year. And Yellow Brick Road Holdings was up 9.38% to end at 7 cents and is down 51.72% over the last 12 months. And McGrath was at 26.5 cents and is down 36.14% over the last year. So you can see how the real estate sector are impacting some particular stocks. The Australian dollar US dollar rate was up 0.05% to end at 17.91 and is down 10.21% over the last 12 months. The gold spot Australian dollar cross was up 1.84% to 1,836 and is up 8.93% from a year ago. The Bitcoin Aussie dollar cross is down 13.41% to end at 4,371 and is down 53.01% over the last year. Over in the US, a wave of green washed over US stock markets on Friday, led by technology companies, as a report on progress in US-China trade talks lifted sentiment, pushing the S&P 500 to its best week since November 2018. The Dow racked up gains on Friday, snapping a 2-week losing streak. China's state-run Zhenhu news agency said Washington and Beijing were making substantive progress on trade talks, providing relief after news that a summit to seal a deal between the two sides would not happen at March end. Many investors expect a deal will eventually happen, but US data showed manufacturing output fell for a second straight month in February, and factory activity in New York State was weaker than expected this month. That followed a batch of weak data this week that lent support to the Federal Reserve's dovish stance on future interest rate hikes. The S&P 500 posted its best weekly gain since the end of November, and the Nasdaq hit its best weekly gain so far this year. For the week, the S&P 500 was up 2.9%, the Nasdaq was up 3.8%, and the Dow was up 1.6%. So looking at the data in more detail, the Dow Jones Industrial Index was up 0.54% to end at 25,848 and is up 3.84% over the last 12 months. The S&P 100 was up 0.54% to end at 1,247 and is 2.46% higher than a year ago. The S&P 500 was up 0.5% to end at 2,822 and is up 2.15% from 12 months back. The Volatility Index was down 4.59% to end at 1288 and is down 21.65% from a year ago. The S&P 500 index was up 0.41% to end at 439.74 and is down 8.57% from this time last year. Goldman Sachs was up 0.40% to 198.26 and is down 25.32% from 12 months ago. The Nasdaq Composite was up 0.76% to end at 7,688 and is up 1.79% over the last year. Apple was up 1.30% to 186.12 and is up 2.96% over the last 12 months. Google Alphabet was down 0.19% to 1,190 and is up 3.8% over the last year. Amazon was up 1.55% to 1,712 and is up 5.98% over the last year. Facebook was down 2.46% to 165.98 and is down 7.61% over the last year. And Intel Corporation was up 1.67% to 54.33 and is up 3.05% over the last 12 months. The United States 10-year bond ended at 2.59 and the 3-month ended down 0.39% to 2.44. The US dollar index was 96.49, down 0.31% and up 7.87% over the last year. Brexit, of course, is rumbling on, with the date extended but little else firming up. The British pound US dollar was up 0.07% to end at 1.3298 and is down 5.18% over the last year. The FTSE was up 0.60% to end at 7,228 and is up 0.74% over the last 12 months. And the FTSE Financial Services Index was up 0.93% to 667.91 and is down 0.61%. And the Royal Bank of Scotland was up 1.09% to 269.80 and is up 3.81% over the last 12 months. The Euro US dollar was up 0.03% to 1.1329 and is down 8.52% over the last 12 months. Deutsche Bank was down 0.94% to 7.81 and is down 37.94% over the last year. And in China, policy targets announced at the start of China's 13th National Policy Congress, the NPC, on the 5th of March underscores the policy challenges facing the government as it seeks to support growth without significantly adding to the economic imbalances. The 2009 GDP growth target was lowered to 6 to 6.5% from around 6.5% in 2017 and 2018, and against actual growth outturns of 6.9% and 6.6% respectively. As Fitch pointed out, the adoption of a lower growth target reflects an acceptance by the government that medium-term growth is slowing to perhaps a medium-term potential growth rate of around 5.5%. Now that's a significant decline from historical trends as the economy rebalances towards consumption and away from capital accumulation. Import growth turned negative in year-on-year terms at the end of 2018, reflecting a slowdown in domestic investment and private consumption. And the official Manufacturing Purchasing Managers Index dropped to its lowest in 3 years in February to 49.2, a third consecutive month below 50, indicating contraction. And as Australia's major trading partner, this could impact the local economy ahead. The Chinese yuan US dollar was up 0.14% to end at 0.1489 and is down 6.16% over the last 12 months. Oil was down 0.34% to 58.41 and is down 3.95% over the last year. Gold was up 0.55% to 1,302 and is down 2.2% over the last 12 months. And silver was up 0.78% to 15.29 and is down 11.91% over the last year. And copper futures was up 0.57% to 2.90, down 8.03% over the last 12 months. And Bitcoin US dollar was up 1.33% to 4,001, but still down 51.59% over the last year. So standing back, it seems to me that international markets are being supported by hopes of more stimulus and trade agreements, which then puts the acid back on the local Australian economy. In fact, it may be that Australia becomes one of the first victims of this current economic cycle. And the fact is that most of the risk has been created by poor government and policy failure. There is no blaming some third party. This is a home-based problem in every sense of the word. And finally, a quick reminder that our next live event will be on Tuesday the 19th of March at 8 p.m. Sydney time. As usual, we'll take questions live via the chat or ahead of time, and you can send me questions via the DFA blog. The link to the blog is in the comments below. I look forward to seeing you then. And if you found this post useful or informative, please like it, add a comment or question. I read them all. And importantly, share it via your social media channels. And if you've not yet subscribed, please ring that bell to receive alerts for future posts. And if you have already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you next time.